Timothy Chubb is the Chief Investment Officer at Gerard Partners. So Timothy, walk me through the way you guys are looking right now at the economic backdrop and what it means for your investment thesis. Is it as worrisome as we were at a couple months ago, or is a couple data points not enough to get us out of the woods?
Yeah, I think we've seen some strong data points recently. To your point, I mean, we certainly have been talking about a recession for 2020. I call that M+1 theory. It's not this year, it's going to be next. But some of the recent data is suggesting that we could see a bottoming out as the year comes to a close and we get through the early part of 2020. And I think it helps to have some perspective. When we look back at this point last year, we had a Fed that was on autopilot. We had a runoff of the balance sheet. The Fed would raise rates one more time. Still dealing with the geopolitical issues with Brexit, U.S.-China trade relations. And so I think the reassuring thing we've seen recently has been the U.S. consumer getting through this manufacturing slowdown. And although ISM manufacturing data was relatively weak in the most recent report, it was the strongest in 31 years for new exports. So we're starting to see some strength and stabilization in the numbers. And I think investors really need to be looking at the base case of a soft landing thanks to the aggressive, accommodative monetary policy from the Fed.
Timothy, the deep concern from earlier this year is a pretty low bar to beat in terms of things improving, right? Meaning that we can get some, 50 or sub 50 manufacturing numbers around the world and people breathe a sigh of relief because they're just not as far sub 50 as they were weeks or months ago. So how do we try as investors to balance that relief a little bit with also the overall nominal figures, which are still pretty sluggish?
Yeah, that's a good question. At least here in the United States, manufacturing is only 10% of nominal GDP. So, as I'm sure you've discussed on the show, services, part of our economy, has become a larger part and has really shown some strength, with the exception of the last report. But the trend has been, in favor of the services sector really doing well within the U.S. But I think a lot of the weakness that we saw that which, sort of initially sounded the alarm where investors began to get more seriously concerned about global growth weakening really came out of Germany and some of their manufacturing data. But it's my view that this was largely, or if not entirely, a result of just what's been going on with Brexit, but also with U.S.-China trade relations and the Chinese consumer sort of pulling back a little bit and tightening the belt. And if we start to get closer to a resolution, which at this point it seems like it would be almost catastrophic if they were to pull away from this phase one deal for the financial markets, that would assume, that with the Chinese stimulus, that next year we could start to see a rebound in manufacturing data. So I think the big thing is, the labor market has seemed to power us through this sort of period of temporary weakness. And what we saw in 2011 and 2016 with this kind of reset mid-cycle seems to be maybe more of the base case for 2020, despite us heading into the uncertain election year.
So, Timothy, given some of the optimism around the latest geopolitical developments, both U.S.-China talking phase one, Brexit trying to move away from a hard Brexit, is this still the potential for the market to have a big event if there's disappointment? Or do we see also, because, we're also here talking about a potential cyclical bottom in things like manufacturing when we haven't even had any concrete deals. So to me, that could also argue that maybe some of the weakness we had wasn't all tariff and trade induced.
Yeah, that's certainly a possibility. I'm not suggesting that we're totally out of the woods. We still have a lot of risks. To your point, a lot of the geopolitical issues still aren't off the table yet, but it seems like we're moving in the right direction. But I think it's encouraging with the way, a lot of the big money has been moving recently. We've seen, this value trade start to pick up here within the U.S. We've seen a backup in rates after a period where I think everyone would agree that they got too low, thanks to some delta hedging and other aspects related to just having $16 trillion worth of negative rates in sovereign debt globally. But I think if we look to next year and if we're able to get through some of these issues, and they're big ifs, but I think we could see just a soft landing within the global growth story. And I'm encouraged so far by some of the data recently. We were not the firm that was sort of saying that we're going to see a recession in the first half of 2020. And I still think there's a possibility that will occur next year. So I'm not saying to investors to load up on all the cyclical stocks and credit within the fixed income portion of your portfolio. We still have a neutral stance with our sector allocation, within our credit allocation, within fixed income. But I definitely think things are, the tide seems to be turning a little bit. And I think the market's responding in a way that is fundamentally healthy, as opposed to just throwing caution into the wind and seeing a major move in some of these cyclical companies.
Timothy, I'm glad you bring that up. It's been the focus of our discussion here, the kind of cyclical and value outperformance over some of the growth leaders of the bull market. It sounds to me, while you're not ready to go out and pick up all these economically tied companies, industrials, material stocks, what about some of the other decent strength we've seen, even in emerging market companies, the Russell 2000, which had been a very substantial laggard, also picking up. There's these kind of value plays outside of just this sort of stock value style or factor basis. Are you interested in any of those?
Yeah, and that goes to my point with, fundamentally, I think the stock market's pretty healthy globally. I mean, from a valuation perspective, we're starting to see a sell-off, or not starting, but have seen almost a bloodbath take place in a lot of these companies with no path of profitability within IPOs. But when you look under the hood, Europe seems to be inflicting higher. Some PMIs within the emerging market economies are moving in the right direction after years of emerging and non-U.S. stocks underperforming. I'm happy to see some investors taking attention to outside the U.S., where if you look long term, that's really where the growth story will be. While we've been able to achieve higher rates of growth relative to the rest of the developed world here in the U.S., it's the aging and growing population, the emerging market economies that are really going to be driving the global growth story for the next decade plus. So I think if you're a long-term investor, these are from a relative value opportunity, great opportunities to continue to add and look to build. Our firm remains underweight non-U.S. stocks by a little bit. If you look at the MSCI All Country World Index, it's about 43% non-U.S. When we're at about 30% relative to our domestic exposure, which would be 70%. But I think it's definitely encouraging to see EM stocks and Europe as a whole start to do a lot better. And a lot of that's going to be thanks to China being such a large weighting within a lot of those benchmarks, which, if we're able to get to a deal, is going to definitely provide a tailwind.
Tim, I'm glad you bring that up. Yesterday we talked about the relationship between the S&P 500 and ACWI, some call the ACWI, the index for, there it is right there as we're looking at in the chart, for the rest of the world. The relationship between the S&P and this index actually peaked around the same time that the 10-year yield bottomed. The last point before we let you go is, I'm curious what you think about the relationship between the bond market and some of this value type rotation into other areas. Does it need to see continued bond yield liftoff for investors to be interested in looking outside the U.S.?
Yeah, not necessarily. I think a lot of what we've seen in rates backing up, it was an overbought condition. With growth potentially inflecting a little bit higher, or at least stabilizing. I think the bond yields need to move back higher, and I think as a result, a lot of these more defensive sectors, like I was on speaking about last time, in consumer staples and utilities and some of the old line telecom businesses, they've gotten meaningfully overvalued, and so we've started to see them sell off. We've seen the financials relative to utilities trade really work out within the last couple of weeks, and similarly, we've seen a lot of the non-U.S. Countries and companies start to do pretty well also. So while I think we could see, a backup in rates continue, if you look back in the last 10 years, the 10 years has been a great predictor of real GDP growth here in the U.S. It's had a 90% correlation. So it tends to be a fairly good predictor, at least recently, of what investors are thinking the 10-year will do from a growth perspective. And if that ends up being the case, maybe plus or minus a little bit here, we're looking still at somewhere around 2.25% GDP growth if everything works out in our favor for next year. So I think a lot of these more defensive sectors could potentially sell off a bit more, but it goes to our long-term thesis over the course of this market cycle, where companies that are able to achieve higher rates of growth in the global economy, or the U.S. economy from a nominal perspective, are going to demand a premium valuation. So although some of these cyclical companies that are going to be highly sensitive to the economic cycle may be doing well in the short term, I think investors should be continuing to look at growth as an opportunity to add to, especially as we I think, will remain in this low growth environment, even if we do have a soft landing from a global growth perspective.
Okay, good perspective here for us, even with some of the improvement, maybe not a runaway train for growth yet. Timothy Chubb, nice analysis here. Appreciate it, sir. Tim is the Chief Investment Officer. Thank you. At Girard Partners.